Okay, greetings, everybody. We are going to start with chapter 2 of managerial accounting. This week, we've got 2 weeks where we're talking about job order costing. But this week, we are going to begin our understanding of job order costing. And basically, what we are going to discuss is the process in which we utilize this job order costing and how we go about preparing for job order costing. Okay, so what is this? Job order costing for companies is primarily used when companies manufacture various types of products each period. And they're very unique and specified products. And they are produced specifically for certain customers. Because of the unique nature of each order, it requires a company to really track the cost to each job and to maintain specific cost records for each job. Think about an automobile you have custom made with a certain type of paint, a certain type of stereo system, a certain type of leather seats, a certain type of engine, upgrades. When something like that is produced, they need to keep track specifically of what is going into that automobile, because it's not going to necessarily be the same for another automobile. It's going to be unique. A house is a great example of job order costing. Examples of companies that would use this, of course, Boeing. When they're creating aircraft, the aircraft is going to be different for who their customer is. Large construction companies, Walt Disney Studios with movie productions, they need to keep track of what costs are associated to what production. So, in this case, the direct materials need to be charged to the specific jobs they're going to. The direct labor needs to be assigned and directly showing the cost for the jobs they were working on. But here's the key. When we're dealing with manufacturing overhead, it's a huge lump of a lot of indirect materials and indirect labor. And they can't be linked necessarily to a specific job because they're the overhead, the factory insurance, the supervisor's salary in the cafeteria. So because there's a big lump of all this, these costs that are indirect, they are allocated to all the jobs rather than directly each specific job. So here we have a job cost sheet. This job cost sheet here, we allocate what the items are. Excuse me. The job cost sheet, let me go back here. I apologize. This shows you what job it is, what the item is, and all the cost linked to this particular item. While a product is being manufactured, they're going to request through a materials requisition form the various items that are needed. Those then will get traced back to the job cost sheet. Time tickets, the direct labor associated with the various products, will also be allocated to each specific job, as you can see here. That also, for this job A143, will be linked to the cost sheet for this specific product. So, the key is to come up with, for the manufacturing overhead, a predetermined overhead rate. Now, no, it has to be predetermined because our costs aren't going to all come in until after this job is done. Therefore, based on history, based on past experience, we need to come up with some type of predetermined rate. And that rate starts by coming up with an allocation base that's going to be used to assign manufacturing overhead to specific jobs. It can be done through direct labor hours, direct machine hours, or possibly even labor dollars. They've got to come up with an allocation that makes sense in their specific company. Why we have to use an allocation base is we can't trace all these overhead costs, all these indirect costs to a certain job. It's impossible. And there's so many different pieces that go into this manufacturing overhead. It's a catch-all, basically. So we got to find a way in which we can assign these costs to various jobs. So this predetermined overhead rate, POHO, predetermined overhead rate, we are going to use to apply various manufacturing overhead to jobs. We have to do this at the start of the period. It's a guess, it's an estimate, but we have to use some method to allocate these costs because it's a significant piece of the cost. We've got to figure out what drives our costs. So we estimate the total manufacturing overhead for the coming period, and we also have to estimate the total units in the allocation base for the coming period. Okay, got to come up with something. So how do we determine it? Actual overhead for the period, we're not going to know it until way after the period is over and the products have been sold. Actual overhead can fluctuate. So we're trying to get it as accurate as possible. So here we see the way we determine it. It's computed before we start the month or the period or the quarter or the year. We estimate the total amount of the allocation base, which is the denominator, the bottom one, that will be required for the next period's estimated level of production. So we estimate the total fixed manufacturing overhead, and we estimate the variable manufacturing overhead. We use the equation Y, being the total estimated manufacturing overhead cost, is going to equal the total fixed estimated plus the estimated variable times the allocation base in order for us to come up with this predetermined overhead rate we can use to apply to the various jobs. So we're going to start with exercise 2.1. Harris Fabrics computes its plant-wide predetermined overhead rate annually on the basis of direct labor hours. At the beginning of the year, it estimated that 20,000 direct labor hours would be required for the period's estimated level of production. The company also estimated 94,000 of fixed manufacturing overhead cost for the coming period and the variable manufacturing overhead of $2 per direct labor hour. Harris's actual manufacturing overhead cost for the year was $123,900, and its actual total direct labor was 21,000 hours. So it's giving us the estimated, and then it's letting us know what the actual was. But our job here is to figure out what the predetermined overhead rate is for the year. So the 94,000 of fixed manufacturing overhead with variable manufacturing overhead of $2 per direct labor hour. Okay. So the way we compute this is we take our estimated fixed manufacturing overhead, the 94,000, and we take what we estimate the variable manufacturing overhead of $2 by 20,000 direct labor hours. Now that 20,000 direct labor hours were estimated. You see that? We estimated 20,000. So our estimated total manufacturing overhead cost is 134,000. We take that 134,000, divide it by our estimated labor hours to figure out that our predetermined overhead rate is going to be $6.70 per actual direct labor hours. What this is helping you see is how we determine the predetermined overhead rate, okay? Okay. Now, I think what I'm going to do is real quick, go to the homework. I'm just going to do a few of these so you can kind of see. So for one of these first assignments, oh, come on. Is it not going to let me? It did allow me to do this in my last class. Okay. So as you see here, Landon Corporation uses a job order costing system. At the beginning of the year, the company made the following estimates. Now it's asking us here, assume that Landon has historically used a plant-wide predetermined overhead rate with direct hours as the allocation base. Under this approach, compute the plant-wide predetermined overhead rate. So the way this predetermined overhead rate is going to be calculated is it's telling us the 140,000 estimated direct labor hours, and it gives us $2 per direct labor hour. So the $2 per direct labor hour times the estimate of 140,000 direct labor hours is 280,000. And then it estimated the fixed manufacturing overhead of 784,000. So the 784 plus the 280 is 1,064,000. If we take that and divide that by the estimated 140,000 estimated labor hours, we're going to come up here with $7.60 per direct labor hour. Remember, estimated fixed, estimated variable times the estimated total hours. Okay. Moving on here. We're now going to take this overhead predetermined rate and apply it to jobs. So if Pear Company estimates that it will require 160,000 direct labor hours to meet the coming period's estimated production level. In addition, the company estimates total fixed manufacturing overhead at 200,000 and variable manufacturing overhead at 275 per direct labor hour. So we know we're going to take the 640, which is our fixed plus our variable times our estimated hours. We're going to add them, divide it by our estimated hours to come up with the predetermined overhead rate of $4 per direct labor hour. So once we have that, we then will find out the actual direct labor hours. So you see, when we take the direct labor hours that got charged to a ticket of 8 hours, we will take our rate of $4 an hour to assign the manufacturing overhead to that specific job. Okay. Luth & Company uses a plant-wide predetermined overhead rate of $23.40 per direct labor hour. This predetermined rate was based on a cost formula that estimated $257,400 of total manufacturing overhead costs for an estimated activity level of 11,000 direct labor hours. The company incurred actual total manufacturing overhead cost of $249,000 and 10,800 total direct labor hours during the period. Determine the amount of manufacturing overhead costs that would have been applied to all jobs during the period. So what would have been applied to all jobs? So we've got here the predetermined overhead rate is $23.40. You see that, okay? The actual direct labor hours is 10,800. So we apply that predetermined rate based on actual direct labor hours, which means we would have applied $252,720 to the jobs during the period. Now you see the real cost they know after the fact is $249,000. But what we truly applied is $252,720. So we over applied, but we don't know that. We're doing the best we can. Next, we're going to compute the total cost and the unit product cost of a job using a plant-wide predetermined overhead rate. Here, we know what our direct materials are for our wooden cargo crate. We know our direct labor hours, and we know what our manufacturing overhead is. So you see that the total cost for this particular job is $268. We take our direct materials, direct labor, and our manufacturing overhead we apply. We've got total cost of $268. But we had 2 of these units produced. So we break it down cost per unit to $134. So guys, I want you guys to look at this one. Job WR53 at NW Fab required $200 of direct materials, 10 direct labor hours at $15 an hour. We estimated total overhead for the year to be $760,000 and estimated direct labor hours were $20,000. What would be recorded as the cost of job WR53? I'm going to give you guys a minute and tell me what you think. When someone has the answer, you guys can reach out. Whoever's ready, you guys can, someone pipe in.
I got D as an answer.
Anyone else? Someone else? Someone else attempt. We're all working together.
I also have D.
Good. Okay. Excellent. So we take our direct materials, our direct labor, and then we assign our predetermined overhead rate based on our actual labor hours. So we calculate our predetermined overhead rate at $38. Okay. Our estimated 760,000 divided by our 20,000 labor hours to get our 730. Excellent, guys. So when you inaccurately assign manufacturing costs to jobs that adversely influence planning and decisions made by managers. So you got to, as much as you can, make this cost driver what drives the cost. We can assign the direct materials and the direct labor. But the negative with this type of job order costing system, sometimes it doesn't always accurately allocate that manufacturing overhead to the jobs it's really producing. But there's a way we got to capture all of those costs. So job order costing uses allocation bases that might not reflect how jobs actually use overhead resources. The allocation base in the predetermined overhead rate must drive those overhead costs to help improve that we're costing correctly. It's the cost driver which we show causes the cost. And you got to make sure that cost driver is effective. A lot of companies will use a single predetermined overhead rate, but it's simple. And sometimes it's overly simple, and it's not going to allocate the cost correctly. So if more than one overhead cost driver can be identified, it might be beneficial to sometimes use multiple predetermined overhead rates, just so you know that. Tech Solutions is a consulting firm that uses the job order costing system. Its direct materials consist of hardware and software that it purchases and installs on behalf of its clients. The firm's direct labor includes salaries of consultants that work at the client's job site, and its overhead consists of costs such as depreciation, utilities, insurance, as well as office supplies. Tech Solutions computes its predetermined overhead rate annually on the basis of direct labor hours. At the beginning of the year, it estimated that 80,000 direct labor hours would be required for the period's estimated level of client service. The company also estimated 680,000 of fixed overhead cost of the coming period and variable overhead of 50 cents per direct labor hour. But the firm's actual overhead cost for the year was $692, and its actual total direct labor hours were 83,000 hours. So both actual overhead and the actual direct labor hours were greater than what they estimated. Our job is to compute the predetermined overhead rate. Okay, so the predetermined overhead rate is estimated by estimated. Fixed estimated overhead cost 680. The estimated variable cost is 50 cents times 80,000 estimated direct labor hours, which is 720,000 bucks. We divide that by our estimated direct labor hours to come up with $9. It's the predetermined overhead rate. Okay. Does that make sense, guys? I want you to catch that because that's just the beginning of determining how we calculate this. Now, what was actually assigned to Xavier? We know the direct materials went there, the direct labor, and we take the $9 per hour times actual labor costs. So our total manufacturing cost here assigned to this job, $61,520. Okay. Going back a minute to this one, to figure out the total manufacturing cost for this job 550. It's going to tell us that what we need in order to determine it. In this case, it tells us that the manufacturing cost, direct materials, let me find it. Oh, it's up here. Tells us our direct materials are 175. Our direct labor is 225. We have our predetermined overhead rate of 760. It told us our direct labor hours are 15. So our 15 times 760, you add those two together, the 175, the 225, and the 760 times 15 actual direct labor hours of 114. We would know then our total manufacturing cost here is going to be 514 for this job. Okay? That make sense?
Yes.
Moving on. Hahn Company uses a job order costing system. Its plant-wide predetermined overhead rate uses direct labor hours as the allocation base. The company pays its direct laborers $15 per hour. During the year, the company started and completed only 2 jobs. Job Alpha, which used 54,500 direct labor hours, and Job Omega. The job cost sheets for these 2 jobs are shown below. So we have Job Alpha's got some, we don't know the answer to those. Let me just, and yet we've got the cost to Job Omega. Our job is to calculate the job cost sheet for Alpha and then to figure out the predetermined overhead rate, okay? So here we've got the total job cost. We know, just right now, we know that they're getting paid $15 an hour. So we could figure out how many direct labor hours are associated with Job Omega. Okay? I'm just kind of talking this out here. So if we know they're getting paid 15 bucks an hour, we could take their direct labor of 345,000 divided by 15 an hour to figure out exactly how many hours were used for job omega. Okay. Then from there, we can figure out the manufacturing overhead rate per hour. It's telling us that job alpha used 54,500 direct labor hours. So we could figure out the direct labor there also. So let's move on and we'll show you. So the total direct labor hours required for job omega would be the 345,000 divided by 15 gives us 23,000 direct labor hours. So if 184,000 was applied to job omega, if we divide that by the direct labor hours, we know it's $8 per direct labor hour. So we can figure out job alpha by knowing they had 54,000 direct labor hours at 15 bucks an hour. We can figure 54,500 manufacturing overhead applied. Excuse me, I think that should be 54,000 times $8 per hour. Then we plug in the different number. So we basically can take we know the labor, we know the manufacturing overhead. This is a plug-in number. Does that make sense?
Yes.
Now, we are going to compute the total cost and the unit product cost of a job using multiple predetermined overhead rates. Dixon has two production departments, milling and assembly. The company uses a job order costing system and computes a predetermined overhead rate in each production department. The predetermined overhead rate in the milling department is based on machine hours, and in the assembly department, it's based on direct labor hours. The company uses cost plus pricing and a markup percentage of 75% of total manufacturing costs to establish the selling prices. At the beginning of the year, the company made the following estimates. So you see, they estimated machine hours for both milling and assembly. They estimated the direct labor hours. They estimated the total fixed manufacturing overhead. And then as a result, we see the variable manufacturing overhead is estimated per machine hour for milling and per labor hour for assembly. During the current month, the company started and completed job 407. It wants to use its predetermined departmental overhead cost and rate for the milling and the assembly departments. So we've got here the milling department, 390,000 times the variable $2 per machine hour. And then the assembly department, the 500,000 times the direct labor predetermined times 80,000 direct labor hours. Okay. Use the amounts determined on the previous slide to calculate the predetermined overhead rate of each department. So for milling, if we take our 510 right there, and we divide it by the estimated 60,000 machine hours, we're at $8.50 per machine hour. The assembly, you see the 800,000 by estimated 80,000 direct labor hours would be $10 per direct labor hour. Now we'll calculate the amount of overhead applied from both of the departments to a specific job. We're going to use that predetermined overhead rates that we calculated here, the 850 and the 10, okay, to determine the overhead applied from both departments to job 407. So we see here in milling, we're going to go by machine hours. If the actual machine hours were 90 machine hours at our predetermined overhead rate of 850, we're going to apply $765 there. Assembly, we're using direct labor hours. So in that case, our 20 direct labor hours at $10 per direct labor hour, we're going to apply 200 there. So to determine all the costs, we've got our direct materials, our direct labor for milling, 800 to 70, and we've got our milling department's overhead of 765. For assembly, we've got the direct materials of 370, the direct labor of 280, along with our assembly department overhead of 200. Okay, we total all that together. The cost of this job would be $24.85. Does anyone have questions with that? Is it making sense? Now, how do we calculate the selling price? If we know the cost and we know the markup is 75% added to the cost, then we'll show a markup of $1863.75. So the selling price of this job is $4348.75. Here they're focusing on the departmental approach. Instead of using one overall application, we are using predetermined overhead rates based on the department, which would make it more accurate in assigning cost to various jobs. It makes sense. Okay, let me go back here to what we were doing earlier and show you if it tells us the cost of job 550 is $514, and they show total manufacturing. If the markup on this job is 200%, 200% of $514 is going to be $1,028. So the cost, $514, plus the markup of $1,028, in this case means our selling price is going to be $1,542. Does that make sense, guys? Yes, no? I'm trying to show you how these exercises, everything we're doing, will allow you to complete the homework. Okie doke. Next, Dell uses a job order costing system and has two manufacturing departments, molding and fabrication. The company provided the following estimates at the beginning of the year. They estimated machine hours and they estimated manufacturing overhead. Sorry about that 700,000 there. We also have an estimate of the variable manufacturing overhead costs per machine hour. Okay. During the year, the company had no beginning or ending inventories. It started, completed, and sold only 2 jobs. Okay. And here's the information regarding these jobs. It gives us our direct materials, our direct labor, and our actual machine hours. Okay. For each job. Dell had no underapplied or any overapplied manufacturing. Assume Dell uses departmental predetermined overhead rates based on machine hours. We're going to compute the departmental predetermined rates, which the departmental predetermined rates, as you see here, is going to be our 760,000 estimated manufacturing overhead. Divide that by our estimated machine hours to come up with $38 per machine hour in the molding department. Whoops. Sorry about that. Okay. In the fabrication department, we've got our estimated fixed plus our estimated variable, $1 per machine hour at 30,000 estimated machine hours. 240,000, divide that by our estimated machine hours to come up with $8 per machine hour. So you see here, they gave us our direct materials, they gave us our direct labor. We take our predetermined rate times actual machine hours or actual direct labor hours to come up with our manufacturing costs per department. Okay. Now, what are the bid prices? Okay, let me just go back here, see our questions. If Dell establishes bid prices that are 150% of total manufacturing cost, what bid prices would it have established for job D70 and job C200? So establishing a 150% markup, you take the cost times 150% for each, and this shows the bid price. Pretty straightforward. The next thing it says, what is Dell's cost of goods sold for the year? Because the company didn't have beginning or ending inventories and only those jobs were completed, started, and sold, the cost of goods sold is going to be equal to the $1,640,000 plus the $1,370,000. Okay. Now, the next part tells us, assume Dell chooses to combine its departmental rates from requirement 1 into a plant-wide predetermined overhead rate based on machine hours. Now what we have to do is compute the plant-wide predetermined overhead rate. So it's going to change everything here. So if we do that, we would have $20. The total estimated manufacturing overhead would be $760,000 for molding, $240,000 for fabrication, or $1 million. And if we divide that by the estimated total machine hours of 50,000 machine hours, we come up with $20 would be the predetermined overhead rate per machine hour. Then, compute the total manufacturing cost assigned to job D70 and job C200. So in that case, if we assign the $20 per machine hour times total machine hours for D70 would be 20,000. Total machine hours for C200 is 30,000. Here is our total manufacturing cost. If our bid price is 150% of the cost, we see what the bid price would be 150% of both those costs. To see, in that case, what the bid would be on the D70 versus the C200. And in this case, we've got manufacturing cost of $3,010,000 versus the other way, the manufacturing cost. Let me just see if let me see. 2,460,000. We had 3,010,000. But if we break them into 1,640,000, 1,370,000, you see by using it this way, the costs really are different, what's being assigned to each of these jobs. The total's, of course, the same, but each job is separate. Okay. Now, the plant-wide and departmental approaches for applying manufacturing overhead costs to products produce identical cost of goods sold figure, but the two approaches lead to different bid prices for each job. The bid price for job D70 using the departmental approach is $270,000 higher than the bid price using the plant-wide approach. This is because the departmental cost pool reflects the fact that job D70 is an intensive user of molding machine hours. The overhead rate in molding was $38, which is a lot higher than the $20, or even in the fabrication of being $8. Okay. Whether a job order costing system relies on plant-wide overhead cost allocation or departmental overhead cost allocation does not usually have an important impact on the accuracy of the cost of goods sold reported for a company as a whole. However, it can have a huge impact on internal decisions with respect to individual jobs. Job order costing systems that rely on plant-wide overhead cost allocation are commonly used to value ending inventories and cost of goods sold for external reporting purposes, but they can create costing inaccuracies for individual jobs that adversely influence internal decision-making. Okay, does that make sense, guys? When a company creates overhead rates based on activities it performs, then they're using activity-based costing, which we're going to talk about down the road. It's another approach of developing these predetermined overhead rates we'll talk about in another chapter. So when it relates to financial statements, the amount of overhead applied to all jobs during a period will differ from the actual amount of overhead cost incurred during the period. So when a company applies less overhead to production than it really occurs, we've got underapplied overhead. And when it applies more overhead to production than it really incurs, then we've got overapplied overhead. The cost of goods sold reported on a company's income statement will be adjusted to reflect the underapplied or overapplied overhead. The adjustment for underapplied overhead increases cost of goods sold and it decreases net income. And it makes sense. If we underapplied overhead, that means we didn't take enough cost, enough expense. So when we adjust for it, we're going to have more cost, less operating income. The adjustment for overapplied overhead decreases cost of goods sold and it increases net operating income. So you've got all your various job sheets, and they are ultimately going to go, if it's still in process, in the inventory part of the balance sheet. And the income statement will have the cost of goods sold, those that were actually sold. We're looking at manufacturing companies, but service companies can use this job order costing also, just so you know. It's common with the manufacturing, but it's still very common in job order costing. That really covers what we're going over for chapter 2. You've got some homework here. Let me go and find, you've got some homework here. Let me try to remove. 4 problems. We kind of started on the first one. You're going to have, again, everything we have done in class should help you in doing this homework. There should not be any secrets here. Okay? These problems are very similar to what we have gone over in class, breaking up the departments, and then the overhead. Okay? Now, the Excel that you will submit for this week, go back here. It's pretty, guys, these Excels are pretty darn straightforward. With the Excel, you're going to, in the first, pull that up, check your worksheet, change the total fixed manufacturing overhead cost for the milling department and the data area to 300,000, keeping all the other data the same. If your worksheet is operating properly, the total cost of job 407 should now be $23.50. If you don't get this, figure out where you went wrong. And then from there, it will say to you, change the total fix to 390, keep all the other data, and in your worksheet, you should figure, be able to figure out what the selling price is here. Any questions at all for this chapter? Anybody? If you have questions, feel free to email me, post questions in the discussion board. I will get this loaded to D2L when we're done here. Any communication, any questions? Do you have anything?